SCHD and JEPQ are two of some of the most talked about ETFs on the market when it comes to dividend ETFs. And in this video, we're going to break down and compare these two ETFs to see which one outshines the other, as well as help you figure out which one would best fit your investing goals. So let's get right to it. First up is SCHD, the Schwab US Dividend Equity ETF. The objective of SCHD is to track the performance of the Dow Jones US Dividend 100 Index. This is an index that focuses on high-quality US companies that have a strong record of paying and growing dividends. SCHD selects companies through a variety of filters, such as they must have paid dividends consistently for at least 10 years, they must have a minimum average daily trading volume of $2 million, a minimum market cap of at least $500 million, as well as there's further filtering down considering metrics like 5-year dividend growth rate, indicated annual dividend yield, return on equity, and more, with the final stock selections capped at 4% per stock and a 25% sector cap. Next is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. Unlike SCHD, JEPQ is an actively managed fund that's run by a group of experienced portfolio managers. The objective of this fund is to deliver monthly distributable income and exposure to the NASDAQ 100 with less volatility. It does this by generating income through a combination of investing in US large cap growth stocks and selling out of the money NASDAQ 100 index call options, seeking to deliver a monthly income stream from the option premiums and stock dividends. This is what you'd call a covered call ETF. A covered call ETF is a type of ETF that invests in a portfolio of stocks and then sells call options on these stocks in their portfolio to generate income. This covered call strategy is how these type of ETFs can offer such high dividend income while also giving you exposure to the underlying stocks in the fund's portfolio, which in JEPQ's case is the NASDAQ 100. Now that you have a better idea of what these ETFs are, along with their strategies, let's get into the comparison to see which one outshines the other for each of the categories. This first category that we have is diversification, so the sectors and the holdings that these ETFs are exposed to. When it comes to the holdings, SCHD contains 103 stocks, with its top holdings in Coca-Cola, Verizon, Cisco Systems, Texas Instruments, and Home Depot. As for the sectors it's exposed to, they include consumer defensive, energy, healthcare, technology, industrials, and a few others. And earlier this year in March, SCHD had its yearly reconstitution, which caused some changes in its portfolio by dropping 17 stocks and adding 20. This caused quite a bump up in sector exposure for energy, as well as a bit for consumer staples. Moving to JEPQ, this fund contains 109 holdings, with its top holdings in some big names I'm sure you're familiar with, like Nvidia, Microsoft, Apple, Amazon, Alphabet, and Broadcom. And for the sectors, you have technology on top, communication, consumer discretionary, and the remaining in a few other sectors. Definitely heavy tech leaning, which you can see it's not too far from what you'd have in QQQ. When it comes to diversification, while they both have roughly around the same amount of holdings, SCHD has more exposure to a variety of other sectors. With JEPQ loosely tracking the NASDAQ 100, it's no surprise that it has a heavy tilt towards the tech sector, along with growth stocks in general. Although these funds have different approaches, I think it's fair to say that SCHD is the better choice here when it comes to the topic of diversification. Next up, let's talk about the dividends. Starting off with SCHD, when it comes to the dividends here, it's no slouch. As of this recording, it has a nice dividend yield of 3.9%, which the dividends are paid out quarterly. And what makes this such a great dividend ETF is not only that high yield, but it has a 5-year compounded dividend growth rate of nearly 11.5%, and to top it off, 13 years of consecutive dividend growth. Year after year, it has offered some impressive dividend growth, which is a big plus for those aiming to compound that income over time. I think this goes to show that SCHD's algorithm does a great job of filtering down to a selection of stocks that continuously offer solid dividends and dividend growth. Now, as we know from the strategy of JEPQ, this fund functions differently than SCHD, and this is how it's able to pay some nice income. The dividend yield of JEPQ comes in the double digits at just around 11.5%, and JEPQ pays out its dividends every single month. There's quite a gap in yield compared to SCHD, but remember, JEPQ is a covered call ETF. Selling call options generates cash flow through the option premiums that JEPQ receives, which is what allows JEPQ to pay out such a high dividend yield, even though most of its underlying stocks are not paying out very large dividends. If we look over the past year, so 12 months of dividend payments, we can see that the amount has fluctuated between 42 to 62 cents, so it can vary from month to month. Since option premiums tend to be higher in volatile markets, the dividend returns will likely be higher during these periods and lower when markets are more calm and stable. So a big driver for JEPQ will be the varying levels of volatility when it comes to the NASDAQ 100. Now, if you look at the dividend growth of JEPQ, you will see that it has increased, but keep in mind that's not the purpose or the goal of the fund, nor should you assume or expect that this will necessarily increase over time. This one is tough because while there is the gap between the two dividend yields, that doesn't tell the full story. These ETFs are not structured the same, nor do they have the same purpose. SCHD is a serious contender when it comes to its long history of consistent and strong dividend growth, coupled with its above average yields compared to similar funds. While JEPQ has a focused purpose of delivering solid monthly income for investors, which it has provided some amazing yields in the few years that it's been around. The reality is JEPQ is going to be the winner here for those that are interested in income, while SCHD is going to be the pick for those that want the mixed bag of capital appreciation, dividend growth, and a great dividend yield. But for the sake of the video, if one has to be picked strictly for dividends, then I'm going to have to say, sorry SCHD, JEPQ is going to have to take it here with that high dividend income. This next category is going to be risk and costs. SCHD can be a rather safe and conservative play due to the nature of its strategy and holdings, so overall it's not really risky compared to many other funds. When it comes to the beta, so the measure of volatility relative to the overall market, which is 1, SCHD has a 10-year beta of 0.86, so definitely lower volatility here compared to the overall market, which is a nice thing to see. When it comes to the percentage of assets in SCHD's top holdings, the top 10 stocks make up roughly 41% in weight. This is a little bit high if you compare it to other dividend ETFs like VYM, which has only around 25%. So big moves in these top holdings can definitely play a role in SCHD's price at any given time. Another thing to note is since SCHD has much more exposure to the energy sector, it does make it a little bit more vulnerable in times when demand for oil is affected, now whether it's related to geopolitical issues or recessionary times. As for the cost, SCHD has a low expense ratio of just 0.06%, costing you $6 for every $10,000 invested. For the risk, when it comes to JEPQ, the first thing to consider is its heavy exposure to those high growth companies in its portfolio holdings. As you saw earlier, these are its top 10 holdings, which make up roughly 45% of the weight of the entire portfolio. And while JEPQ does give you some more cushion than a 100% exposed NASDAQ 100 fund like QQQ or QQQM, thanks to those options, it's still vulnerable to large price swings and drawdowns. The next risk to consider is underperformance due to capped potential of capital appreciation. This isn't something unique to JEPQ as it comes with the territory of a covered call ETF. Since selling a call option forces you to sell your shares at the strike price if the option is exercised, you don't benefit from any additional increase in the share price beyond this point, which caps your upside potential. To show you a quick example, the line on the x-axis that ranges from 37 over to 43 is the stock price. This dotted blue line here is the stock position, so if you're holding the stock or fund, and the solid green line here is the covered call position. The option strike price in this example is $40. As the share price starts to increase, which is going more towards the right, once $40 is hit, that's where the upside is capped, where it starts to flatline since you're obligated to sell the shares here. But if you take a look at the stock position, it's continuing to go up, benefiting from the increase of the share price. So that's what it means when I say capped upside. And you can see on the bottom end of the lines, the cover call position has the same downside risk as owning the stock. Now for cost, JEPQ has an expense ratio of 0.35%, which is a bit higher, but is to be expected for a fund that's actively managed. I think the less risky of the two ETFs is pretty easy to point out. JEPQ is going to have more volatility due to the exposure of those growth companies. SCHD is pretty straightforward in its approach, and while it has some risk, like any ETF that holds stocks, It's much more balanced and less volatile than the overall market. For that, I think SCHD is going to have to take the win here as a much safer play. Next up on the list is taxes. These two dividend ETFs not only differ in their strategies, but also on how their dividends are taxed. SCHD pays out qualified dividends, which are going to be taxed as capital gains instead of ordinary income. This lower tax rate as capital gains will depend on how much income that you've earned in the year. For example, for 2025 tax brackets, if you're married and earn under or up to $96,700, the tax rate will be 0%, and then a rate of 15% for income between $96,700 and $600K, and so on. These tax advantages are a huge plus for income earned from these type of dividends. For that reason, you can see why these types of dividends are going to be best. Now, JEPQ, on the other hand, operates a little bit differently because of how it generates that income for you. Instead of directly selling call options, JEPQ packages them into something called equity-linked notes, or ELNs. The use of ELNs allows the fund to pass through the premiums it earns for investors as dividends, and the income generated from selling those ELNs are taxed as ordinary income. And ordinary income, also known as non-qualified dividend income, is taxed at your regular tax rate, which you can see from 2025 income tax brackets. It's night and day when compared to qualified dividends, as you're going to be getting taxed much more right from the get-go, starting from the lowest tax brackets. For this reason, you can see why it'd be best to have a fund like JEPQ and a tax advantage account. For both of these ETFs, having them in a tax advantage account is going to be the best choice to avoid taxes on dividends. But for the taxable accounts, qualified dividends are going to be more tax efficient for investors compared to non-qualified dividends. This makes SCHD more tax efficient than JEPQ and its ELNs that are taxed as ordinary income, so I'm going to have to give the win here to SCHD. This next category is all about the total returns, and that's going to be performance. SCHD has had annualized returns of around 12% in the last 5 years, and around 10.5% in the last 10 years. I think in more recent times, it has been a bumpy road for SCHD in terms of returns. It doesn't help either that two of its largest sectors that make up this fund, energy and healthcare, have not been performing the best over the past year. But don't let that take away the big picture from you. Over the long term, which is what really matters, SCHD has given some good and steady returns. Since JEPQ has only been around since May of 2022, it doesn't have much of a history of returns, but since it's been established, it's had annualized returns of around 13% when you consider the price appreciation and dividends. JEPQ has shown some solid results and has managed to outpace more traditional funds when it comes to total returns. And while this is a great number and higher than a more conservative fund like SCHD, you have to keep in mind this fund is not about long-term capital appreciation. It's still a fairly new fund, and it'll be interesting to see how it performs once there's some more time under its belt. In terms of long-term growth and capital appreciation, SCHD is going to be the better choice, as JEPQ's purpose is for the income-focused investor. But if we're strictly looking at the numbers here in terms of total returns, JEPQ is going to be the winner. The returns for the time that it's been around have been solid, but we'll have to see how that holds up as the fund gets older. After going through all the categories, let's see how these funds stack up. Out of the 5 categories, SCHD takes the win here with 3, while JEPQ came short with just 2 wins. Now, after going through each of these categories, I'm sure that you could see, depending on the type of investor you are, your strategy, and age, that one fund might not fit your needs, regardless if some metrics might be better in one category or another. Both of these ETFs are great choices, but it's not necessarily an apples-to-apples comparison. SCHD leans more towards the long-term investor that's looking for appreciation combined with dividends, while JEPQ is more for the income-focused investor. The best fund is the one that fits your needs, and that could even include a combination of both of these ETFs, but that's ultimately for you to decide. Now, if you want to see some great ETFs to combine with SCHD to create a powerful ETF portfolio, be sure to take a look at this video here, or if you're interested in learning about some other great monthly dividend ETFs, then watch this video here. As always, thank you for watching, and don't forget to tap that like button and subscribe if you liked the video. Keep on investing, and I'll be seeing you on the next one.